and the banks are not pricing their mortgages accurately anymore. So essentially, a lot of these banks, let's take specifically the Bank of Montreal, CIBC, and TD Bank, the housing market, subprime risk in Canada has grown exponentially over the past 10 years, but now it is coming to head and most of the public is blissfully unaware of what is happening and what is coming. So the housing market has been on this path of unsustainable growth in Canada for the past 2 decades. A lot of people have misunderstood what is happening, have conflated many different arguments and tried to make logical explanations out of this market, but most of what this market has been built on is speculation, whether it's been Airbnb or whether it's been foreign investors buying properties for future price growth, essentially speculating, or whether it's been domestic investors speculating in the housing market. It is all coming to head right now, and the banks are not pricing their mortgages accurately anymore. So essentially, a lot of these banks, let's take specifically the Bank of Montreal, CIBC, and TD Bank, all have mortgages on their balance sheet that is negative amortization. What is negative amortization, you ask? Simply, it is the balance is increasing on that mortgage, so the person isn't paying. Essentially, it's what I like to refer to as a shadow default. So as you've probably been aware, if you look at their stock price, it's not doing terribly great right now. It is still doing much better than you would think considering the amount of risk on their balance sheet. Now, with one bank in particular, I'm talking about CIBC, the risk is even higher because the mortgage part of their business is such a large percentage of their business, and they are currently being audited by the OSFI right now due to LTVs being completely out of whack. Now, an LTV is essentially a loan to value ratio, and what has happened at CIBC is essentially you've had people borrowing more on their home than it's actually worth. Who would have thought it? So the thing is, the mispricing of these mortgages is not reflected in the bank's stock, and essentially that could mean that the stock is going to correct by a lot. Now, I'm not saying I'm shorting it. I'm not planning on shorting it because shorting comes with incredible amounts of risks, especially when it comes to the banking sector in Canada. I wouldn't want to take that trade. I think there's far more profitable trades out there right now. But what I am able to see is the sheer amount of risk that is in the Canadian financial system that other investors just simply aren't seeing. You see, the EU actually came out with a paper and they actually said that negative amortization was a very bad thing that contributed to the 2008 subprime crisis in the US. That a lot of these negative amortizations were the reason why borrowers owed more on their homes than their homes were actually worth. And coupled with home equity lines of credit and all these different other things that people have supported themselves with over the economic turbulence that we've seen over the past few years, it is ultimately a recipe for disaster. And in Canada, people have seen their real wage growth drop by unbelievable amounts. I mean, pensioners who are on fixed income have seen the amount needed to retire or continue their retirement go up by upwards of 70%. So essentially they need 70% more to get back to the same standard of living that they had in 2019. It's just an insane amount, and it shows you how much inflation has really got up. As we know, the government's number, the CPI, is not accurate at all. And this is one of my biggest points, and I believe that people really need to listen closely here, because the CPI is part of the reason why the monetary policy has been so bad over the past 2 decades. In 1992, the Bank of Canada was targeting 2%. That's when they decided to start targeting 2%. Now, funnily enough, it came after a major recession, which happened between 1990 and 1992. And coincidentally, the yield curve is as inverted as it was back then right now. But the thing is, after that recession, they decided that, hey, we need to get the Bank of Canada targeting inflation inflation, so they gave them this 2% target. And what happened after that point is the CPI just got more and more manipulated. At the end of the day, the Bank of Canada relies on information that it is fed through the government by Statistics Canada. And whether you're looking at the way the Fed is set up in the United States or the way the Bank of England is set up in the UK, it's exactly the same thing. The government is feeding them the data. So even if they were completely independent, which they're not, then they would be making wrong decisions and the government would be able to influence what they do massively through the data. And that is exactly what we've seen happen. The CPI is completely manipulated. If you believe inflation really peaked out at around 8 to 10%, you are completely on a different planet to the planet that most of us are on at this channel. Because the reality is that when you look at inflation, it's been more like 70% since 2019. So how on earth have people stayed ahead over the past 2 to 3 years? And they've done so by going more and more into debt, by subsidizing their lost income with debt. And we see no better example of that than the negative amortization that is going on in the housing market. People cannot afford those higher interest rates, so guess what? They're not paying them. And there is a lot of sellers. There is a growing amount of people who are planning on selling their house over the next couple of years, which could potentially mean a housing market crash. If you couple that with a bad recession, which the yield curve is pointing to, and credit tightening, which is starting to happen at places like Scotiabank, you could see a massive housing market correction. Now, what that nets out to in real terms is a totally different story, but I always like to look at real price growth versus nominal price growth, because essentially you have to adjust it to people's wages to get an understanding or idea of where you're netting out. Because if a asset appreciates by 5% but people's incomes only went up by 2%, then it has appreciated a net 3%. But if people's incomes went up by 1% and the asset stayed flat at 0%, then it declines by 1%. And this is very much the situation that we could see happen in the housing market in Canada, is which it grinds down slowly, and it grinds down in terms of real price growth, which is what I like to look at. So essentially imagine it like this. You see 4% inflation or you see 4% income growth for the next 10 years and the housing market is flat. That would mean that housing prices went down 40% in real terms. Now the reality is, would that be allowed to happen, and is that likely to happen with what is happening with the government, their rampant deficit spending, which is leading to a point of decline against the US dollar that has been in a solid decline for nearly 10 years now. So the thing is, the Canadian dollar has been declining just like the British pound, and it is due a very big correction like we saw in the pound when the pound crashed last year. What this could all mean is a toxic situation in Canada where you have inflation that is rampant like we have right now, where you have asset prices that are falling, where you have credit tightening, and where you have essentially businesses laying people off and you have high unemployment. I mean, we all know the figures that the government put out are incredibly manipulated. Even the unemployment figures, as we went over in a recent live stream, the seasonal adjustments that they make, who knows what they really are, and they often get revised years later when it's found out that we were actually in recession right now. And if you don't believe we are in a recession right now, then you are on a different planet, exactly like the people who believe the government's numbers for inflation. The fact is, unemployment is a lot higher than the unemployment rate is even telling you, even though that has gone up and is rising in specific provinces in a steady trend right now, which is not good. And you've also got GDP growth that is moderating. I mean, you have a toxic situation here in Canada where the economy has become so dependent on housing, and housing has reached the limits of growth right now. As housing stagnates, that means that people cannot make enough profit in this industry, which has become such a large industry in Canada that it leads to more people getting laid off, and it leads to less business investment, and then it leads to ultimately a doom loop situation where you've got unemployment rising, you've you've got growth declining in real terms, and then you've also got inflation. The dynamics that we have in Canada are really quite scary, and I think a lot of people are underestimating what's going on in Canada. But the thing is, it's important to remember here that just because all these things are going on in Canada does not mean that you cannot protect yourself against them. And you know what? I cannot give you specific advice through this video, but right now, all I'm doing to protect myself is I'm buying treasuries. I'm accumulating treasuries in US dollars, and I essentially am getting a steady yield of 5.5% on those treasuries, and I'm happy to sit in treasuries and wait. And even though I know purchasing power is declining, I know over time the US dollar is just going to strengthen, especially against the Canadian dollar, and I also know that those treasuries will appreciate if they cut rates, and I know that I'm getting paid that 5.5%, which is better than getting paid 1%, 2%, 3% at the banks, and getting paid that dollar interest in Canadian dollars. I'm getting paid it in US dollars, which I much prefer. You see, I believe really Canadians need to focus on acquiring US assets or US dollar denominated assets as opposed to Canadian dollar denominated assets, because the Canadian currency is going to experience a significant amount of weakness over the coming years, I believe. And we've seen that. You know, the Canadian dollar has been consistently declining for a decade now. We've seen that the currency has been specifically weak, and it's not going to get any stronger when you consider the decline in the natural resource sector that we have. So it's going to be interesting to see where things go in the future, but there's a lot of headwinds on the Canadian dollar. And the thing is, it used to be coupled to natural resources and oil when that sector was expanding, but now the fact is that sector is contracting because of the federal government and government policies, and it would take a long time to restart that to a sector of growth, even if you have a government change at the federal level. And a lot of people don't understand that. You see, politicians always want to promise that they're going to get you back to everything is great, the economy is booming, but the fact is no politician is going to be able to come in and fix something that has been smashed to 1,000 pieces. And if they can fix it, it's going to take them an incredible amount of time to fix it, considering the amount of pieces that it has been broken into. So we will continue to monitor things here at the channel. If you're looking for a VPN, go to expressvpn.com/marketmania. If you want to help support this channel and the content that I bring to you, go to Patreon. Link is in the description and the pinned comment. If you've enjoyed this video, you might like this video here. You might like this playlist that I picked out for you there. Thank you so much for watching.